Companies have been very profitable in the last year and a half, especially given how big the recession's been. So from the micro standpoint, shares look attractive, and we've got quite big weightings in equities. But on the macro side, events are much more tricky. Now in Asia and the emerging world, they're fine. They're growing nicely and growing very fast, in fact, and they don't have the problems that we do. But in the mature parts of the world, we've had a huge balance sheet recession, which has forced governments to use a lot of monetary policy and fiscal policy to stimulate the economies. And the result of that is we've got huge government debt levels have been incurred. And those high debt to GDP levels added to the fact that there are significant off-balance sheet liabilities, particularly in the UK and the US. And then the fact that we in these societies expect to be looked after or subsidised in our old age, and the fact that the demographics is going to turn quite difficult soon, because firstly we're all living a lot longer than we ever did before, and secondly the post-World War II baby boomers are about to retire next year, means there are going to be immense pressures on the state. And my view on this is that the UK, the US, France, the US, all which are viewed as very stable economies now, these governments will be forced at some stage either to default or inflate. Now, of course, they're not going to default because we will print money. There's no way big nations like this will default. But they have to, in my view, inflate, which would reduce the real level of the debt levels. It's not good for bondholders, but it's, in my view, the only way they can get by. So we've got a strange dichotomy. On the micro side, shares look good, but in the macro, particularly in the West, things are quite tricky. Well, we have large positions in equities. About 4/5 of the fund is in equities. They are mainly very large companies, so nearly 3/4 of the stocks we hold are in FTSE or FTSE equivalent international companies, many of them in big global macro names that you'll all be familiar with. And I'm very happy, despite the bad macroeconomic backdrop, I'm happy to be in these stocks. One reason is that if you can look at what else you can be in, the shares look a lot better. So take cash, for instance. Cash has a yield, which is the interest rate, of about 1% in this country. Inflation is between 3 and 5, depending on which measure you decide to use. So if you hold cash for 1 year going forwards, you'll get 1% in it. Inflation will be 3% or 5%. You are locking in a guaranteed negative real return. So cash is not a great place to be. Same for bonds. I mean, even if you just take the level of bond yields at, say, 3% or so, which is in many parts of the West, it's a very low level versus, say, inflation in this country of 3 or 5. And that's without even thinking about the worries that I have in terms of the huge issuance coming forward and the ability of these governments to deal with inflation. Turning to government bonds, we have substantial short positions here, which reflects the fact that I think inflation will be coming through in the West, and also reflects the almost insolvency or potential insolvency of some of these big countries. I view bonds very much as being a position where you're in the 1960s, where you had a very low yield and you thought it was a stable world, but actually it wasn't. You had a lot of inflation later, which did a huge amount of damage to bondholders, and I think we will repeat that. So because this fund is able to short government bonds, we've been able to take advantage of this, and we have substantial short positions particularly in Japan, the UK and the US. And I view these short positions in some ways as will offer downside protection. They will make money, but I think it will be downside protection, because if bond yields went up sharply, it also wouldn't be good for equities, but this fund should do okay. Now, turning to currencies, our biggest position here, and very much a core position for us, is that we are long of the Asian countries, the emerging ones like Singapore, Malaysia and Taiwan, and short of the big 4 reserve currencies, which are the sterling, the euro, the yen and the dollar. And the rationale here in some ways is obvious, in that the Asian countries have much better economic backdrops. So they have vastly superior demographics. They have much fewer taxes and regulations than we do. They've got far sounder public finances. So it's very hard to envisage a situation where these countries, over any long run, 5, 10, 15-year view, don't grow significantly faster than we are going to in the West, and we are taking advantage of that via the currencies. Lastly, turning to commodities, we have cut back our positions in commodities over the last number of months, partly because they've been very strong performers. But in some ways, we prefer to be short of government bonds than long of commodities, because the downside from being long to something like gold, which we still hold, if we were wrong, it's quite high, because gold's gone up 6 times in the last 11 years. So if we were wrong on this, gold could go down quite a long way. But the downside from shorting, for example, a Japanese government bond yielding a little more than 1% is really very, very low. So though I am still optimistic for commodities, and I think the backdrop is a good one for them, we've just switched some of our position effectively into shorting government bonds, which will respond to the same sort of stimulus. And looking forward, I think it'll be more of the same in some ways, in that shares look cheap on price-earnings ratios, but the macroeconomic backdrop is going to be very tricky in the West. There's no way that the sovereign debt issues can even be resolved at any stage in the next 1, 2, 3, 4, 5 years. And the news is only going to get worse there, in that at the moment we're worried about Greece and Portugal and possibly Spain, but at some stage, on any long-run view, we will be worried about the UK, the US, and Japan. So those are negatives, but this fund is well placed to deal with this, because we don't have to be fully invested, and we haven't always been fully invested. So when shares go up, I'd anticipate that we will sell some, and when they go down, we will certainly be a buyer. But I'd very much anticipate shares in particular being the lead item on the news a number of times in the next number of years. But I think that'll be a buying opportunity. It always has been in the past, actually. It's a very good piece of advice is, once shares have been lead item twice in a row, twice running on news at 10, then it's always invariably been right to buy shares. That's been right all in my career. Other things where I'm confident, I'm confident on our Asian currencies. I think it's not going to make us a huge amount of money in the short run, but it's just a very solid, long-run, gentle growth situation there. And as I say, our bond shorts, I think we will offer very good downside protection to work for when markets get tricky. So overall, I'm confident this fund is very well placed.